All right, statement of cash flows. This is the last of the financial statements that of the four that are required by the SEC and by most banks and certainly all the audit firms. If you're going to have an audited set of financial statements, you need an income statement, you need a statement of retained earnings or a statement of stockholders' equity, one or the other. Increasingly, people use statement of stockholders' equity where they reconcile all of the lines in contributed capital and retained earnings. And then the balance sheet, of course, and then lastly, the statement of cash flows. And that's the order in which you have to complete them. You have to calculate net income in order to do your statement of retained earnings, because retained earnings is beginning retained earnings plus net income minus dividends. I'm going to talk about that here in a second. Once you do that, you can finish the balance sheet. And then once you have a comparative balance sheet, you need a beginning and ending balance sheet in order to do this statement. All right? So this statement is arguably one of the most important ones. Why? If you remember all the way back to the very first week of Principles of Accounting 1, in that very first chapter, there was two overarching goals for all commercial operations. Here's a good trivia question for you. Anybody remember what they were? What does everyone have to do in order to survive in business? You have to have profit and you have to maintain liquidity. You can be the most profitable company on the planet. You could have literally reinvented the industry that you're in. But if you can't maintain enough cash flow to pay your bills when they're due, you're done. It's over. Especially when you have to announce to your employees they're not getting paid on Friday. Don't do that from the office. Don't do that where they can find you. Go hide someplace and call. That's my advice. I've come close a couple of times in my career. Never had to make that call. Came really close. All right, so also, if you're going to enter into a contract for a critical supply of some sort of raw material or a finished goods, you want to make sure that that company maintains their liquidity. If you're going to go to work for a company, don't go to work for Blockbuster. All right? You can avoid it. Look at their financial statement. If you're going to start selling to a new customer and start extending credit to them, make sure that they can pay you. All right? So it's all contained here. This is what the FASB requires in the standard where they require this. So liquidity and solvency is what this statement is all about. So this is a statement. You want to be able to generate future cash flows. You want to be able to pay back the financing that you've had and so forth. All right. So this statement is broken down into the three activities that companies are involved in. Also in that same chapter in Principles of Accounting 1, that textbook that you have long since sold for used. Operating activities, investing activities, and financing activities. That's what businesses are involved in throughout the year. Operating is where they spend the bulk of their time. That's what you get up in the morning to do. That's all the sales of your goods and services to your customers. The collection of that cash, the buying of new inventory in order to keep the shelves stocked. Everything that you get up on a daily basis is operating activities. When you generate excess cash flow and you have the ability to expand your business by buying new property, plant, and equipment or moving into a new geographic area, starting up a new product line. Those are investing activities. And then how do you pay for this expansion? Do you go out and borrow the money? Or do you go out and sell stock? Those are financing activities. All right? So that's the breakdown. Operating activities, the day in and day out, this is cash receipts from the sale of goods and services to your customers, the collection of your accounts receivable. If you finance some of your sales by issuing notes receivable and your customers are paying you interest on that notes, that's part of operating activity cash flow. Receipt of any dividends on investments in equity securities. You go out and you invest in a subsidiary of some sort, and they pay you dividends as a shareholder.
So ideally, operating activities for a company should be positive.
Absolutely, yes. If you go in your initial review of a financial statement for a company that you're going to go to work for, sell to, buy from, whatever, you look at this statement and they're negatively cash flowing operating activities, alarm bells should be going off in your brain. I agree. It's, yes. Now there is ups and downs, that may have, and you always will want to do some, horizontal analysis from year to year, but that's not a good thing when you're negatively cash flowing operating activities.
So you want like the 10K, because quarterly would it make a difference?
No, I wouldn't worry about quarterly because there's seasonal fluctuations in all industries. So.
And this applies to both manufacturing and service?
Absolutely. Anybody. Yeah. You should be generating positive cash from what you get up in the morning to do. You really should be. So if you're not, then there's some issues. The outflows are paying for inventory, other services and goods that you use on a daily basis, your wages that you pay to all your employees, the taxes to government, and then your interest that you pay to your lenders. So that's what's coming from operating activities. Investing activities, cash inflows, are pretty straightforward. They're the sale of property, plant, and equipment. Sale of investments that are classified as either available for sale or held to maturity. So in other words, in that investment section of the classified balance sheet. Repayment of loans. You're loaning to your customers and they've now paid back some of that principals. Cash outflows is buying new property, plant, and equipment. Buying new intangible assets, buying new natural resources, going out and buying some more investments. Making a long-term loan to one of your customers. Financing activities is the last section, and this is cash inflows is the sale of your stock. Borrowing new financial instruments, whether it's a sale of a new bond, issuing a short or long-term note, signing a capital lease, signing a mortgage. Outflows includes the payment of dividends, buying treasury stock, or paying back the loans that you borrow. Okay? Yes?
So should the investing and the financing both be positive as well, or they can fluctuate?
No, they would fluctuate.
Okay,
Yeah.
So then either way, close.
Yeah, because if you're investing, if you're an expanding company, very healthy, you got a lot of growth, your investing is going to be negative because you're buying new property, plant, and equipment. You're buying new plant assets and such. Yeah. So. All right. So. Your authors, and this is where we differ philosophy-wise, your authors here have a footnote section in their statement of cash flows for non-cash investing and financing activities. So a great example is what we just got finished doing on the midterm. We went out and we acquired a piece of equipment with a capital lease, right? Acquiring new equipment is an investing activity. that 475 from the midterm. That's an investing activity, purchase of leased equipment. Signing that lease and incurring the new capital lease obligation in the debt section of your balance sheet is a financing activity. The authors of the book put it down as a footnote. They, at the very bottom of the reconciliation of cash, they put a little footnote at the bottom. Non-cash investing and financing activities, where you would say acquired equipment under a capital lease, $475,000. I disagree with that. I don't like that presentation. So all the problems I'm going to do on the board, I'm going to split them into the two appropriate sections. So I'll put a cash outflow in the investing activities of 475, and then a cash inflow in the financing activities of 475. I just think it makes for a easier to read financials. You don't have to go digging around at the bottom of the page to find out what else is going on. All right? And it is two separate, distinct activities. All right? So I disagree with their presentation, but I want to bring it up. All right. So here's the operating activities. And I'm going to give you a 50-50 chance. This is operating activities that starts with net income and then makes various adjustments for non-cash items. We'll also be putting in here non-operating items. And then some adjustments for working capital. So who can tell me, is this a direct method or an indirect method? Who votes for direct? You guys aren't going to vote for either one, are you? I'm going to sit there and go, okay, who votes for indirect? Okay, we've got a couple of brave souls in the back of the room. The rest of you are cowards. This is indirect, okay? The direct method has cash inflows and cash outflows. The indirect, which is only used in the United States, the rest of the world does not allow the statement of cash flow to be presented in the indirect method. So this is a uniquely U.S. way of doing things. We start with net income and then we make various adjustments for non-cash expenses. That includes depreciation, amortization, and depletion. Okay? Then we add or subtract any gains or losses that are not operating in nature. Okay? So, this has a gain from the sale of land that was listed in the income statement. You're not in the business for buying and selling land. That's not part of your operations. It's part of your investing activities. Proceeds from sale of land. So you need to remove it from net income. And then you take all of the current assets and the current liabilities. So the current assets and current liabilities sections of the balance sheet, you look at increases and decreases. And they've got two each. There's a decrease in accounts receivable and an increase in inventory, and then a decrease in accounts payable and an increase in salaries payable. Current assets have an inverse relationship to cash. If accounts receivable goes down, cash goes up. Because think of it conversely. What happens if your accounts receivable balance goes up? What in reality is going on with your customers? They are not paying you. So if they aren't paying you, your cash balance goes down. So an inverse relationship. If you go out, if your inventory goes up, that means you're buying more inventory. If your prepaid expenses go up, prepaid rent, prepaid insurance goes up, you're paying more for insurance policies. Current liabilities have a direct relationship with cash. If your accounts payable balance goes up, what are you not doing to your vendors? Everybody knows that. Best way to increase cash flow, don't pay anybody. It's not sustainable. It will only last for a short, glorious period of time. And then people will get angry at you. All right? Okay, so current assets, inverse relationship, current liabilities, direct relationship. Add all that up. This particular Braun Corporation for the year ended December 31st, 2013 had net cash provided by operating activities of $15,500. Investing activities. This is the rest of the asset side of the balance sheet. So everything on the asset side of the balance sheet other than current assets. So this is any acquisition, payment for purchase of building, payment for purchase of equipment, proceeds from sale of land. So if I give you a comparative balance sheet and I tell you the only transaction in the land account is the sale of a plot of land, with nothing but the balance sheet and the income statement, how would you calculate the proceeds? If I don't tell you how much you sold the land for. Let's say the land goes down, in this case, $9,100. So the land account started the year, and this is the only piece of land you own, started the year with $9,100 balance, and at the end of the year it was zero. So what other piece of information do you need to know in order to calculate the proceeds?
Was the 9,000 the original value of the land?
Yeah, the original cost would be the $9,100. So if you had a $900 gain on the income statement, then the proceeds have to be $10,000. So you can calculate the sale price, the cash price of these assets, if that's the only transaction that's going on in there. All right? Okay. And then lastly, the financing activities are then the rest of the liability side, long-term liabilities on the balance sheet, plus all of the stockholders' equity. Proceeds, so if your common stock went up $18,000, you issued more common stock. If your bonds payable went up $12,000. If your notes payable went down $13,000, you're repaying the note. So just like the proceeds from the sale of the land, how would you calculate with just the income statement and the balance sheet how much you paid in dividends? If I gave you the beginning and ending balance of retained earnings, and I also gave you how much net income was, that's all you need, right, to calculate dividends. You take the net change in retained earnings and you compare it to net income. The difference is dividends. Because you start with beginning balance of retained earnings, you add in net income, and then you subtract dividends to get ending balance. So if you know beginning and ending balance and you know what net income is, whatever the difference between those two numbers are has to be dividends. Okay? So you'll be able to calculate that on your own without me spoon feeding it to you. All right, so here's the entire statement. Starting with net income, operating activity, cash provided by operating activities. Investing activities is a negative, so that's net cash used for investing activities. And then financing activities is a positive, so that's net cash provided. Add those three sections together, you get a total net increase in cash of $1,500. Add that to the cash on January 1, and you get the cash on December 31st. So this is another financial statement that you know at the end whether you've got all the pieces put together right. Yeah.
Would it be better to evaluate financial ratios based off of cash flow statements because they're all tied back to the original income statement?
You can do some, not all of them. Some of them you have to take average balances, you know, like the number of days sales and receivable or the number of days in inventory. You have to, you know, pick the sales and the cost of goods sold out of the income statement. So that those pieces won't be on here. But there are some on here, yeah.
So do you think it would be better to evaluate a company at all?
It's the best way to start. I mean, anytime I look at a company, even when I was in business, when I was looking at potential, because I was always having to do, you know, credit evaluation before we extended credit to customers. And so I would look at their financial statements. I'd always look at the cash flow first. And then I'd focus with this number, cash flow provided from operations. I'd start there. That gives me a general good feel that they're a healthy organization if they're throwing off cash flow, positive cash flow. Okay? All right. This is that non-cash transaction. They acquired a piece of land by issuing common stock, and so they put it down in a footnote. Investing and financing activities not affecting cash, like I mentioned before. All of my presentations on Thursday and next Tuesday, I'm going to put those into their individual sections. So I'm not going to present it this way. I don't agree with it. All right, so what's the direct method? Well, the direct method is calculating cash inflows from customers and then calculating all of the cash outflows. So if I gave you an income statement and I told you that what sales were, and all sales are on credit, and I also gave you the comparative balance sheet, how can you calculate collections from customers? Keep the math simple right now. If you had $1 million in sales, how much of that did you collect in cash from your customers throughout the year? And accounts receivable went from $500,000 down to $400,000. So accounts receivable started the year at $500,000 owed to you from your customers, and it ended the year at $400,000. How much cash did you collect on $1 million in sales? $1,100,000. Does that make sense? Because you've decreased your balance in accounts receivable that positively affected cash. Cash outflows, payments to suppliers. This one's a little trickier. If you take your cost of goods sold for all of the inventory that you sold during the year, what other accounts, plural, would you have to analyze in order to calculate how much cash you actually sent to your suppliers? I'll give you a hint. It's one asset account and one liability account, both current. One accounts payable is one of them. As you pay accounts payable, you're sending this cash payments to your suppliers. What's the other asset account? No? No? Inventory. Because if inventory levels go up, you're buying more from your suppliers, and then depending upon what happens to accounts payable, you have paid them. All right? So I'll show you the. So here we've got sales revenue of $70,000, cost of goods sold of $29,000. Then we've got salaries and that a loss on sale of equipment, and then we've got an income tax expense. Accounts receivable went down by $2,600. Inventory went up by $2,000. Accounts payable went down by $7,000, and salaries payable went up by $800. So let's walk through these three calculations. I want to know the cash received from customers, the cash paid to suppliers, and the cash paid to employees. We figure those three out with this information, and I'll let you go enjoy the rest of the day. So what is cash received from customers? You sold them $70,000 worth of revenue throughout the year. Your accounts receivable went down by $2,600. So how much cash did you receive? You add them together. So $72,600 is cash inflows from customers. Does that make sense to everyone? Does everyone understand that? Yes. All right. So what is cash paid to suppliers? You had cost of goods sold of $29,000. Inventory went up $2,000, and accounts payable went down $7,000. What was total cash paid to suppliers? You're going to start with the 29. Are you going to add or subtract the $2,000? You're going to add that because inventory went up. That means you must have bought more inventory. Accounts payable went down. You're going to add or subtract the $7,000. Subtract it. So $34,000. 29 minus 2 plus 7. $34,000 is cash outflows to suppliers. The last one is, what was cash paid to employees? You had salary expense of $13,000, and salaries payable went up $800. You're going to add it or subtract it? Yes, ma'am.
The book says to add the 7,000.
Yes, you're going to add the 7. You're going to. Oops. That's right.
Yeah.
So you're going to take the 29,000, subtract the 2, and add the 7. Right?
Yeah.
Yeah, and that's 34.
It says to add 38,000 total. Paid to suppliers.
Here it is.
Yeah.
Oh, that's right, because you're paying extra out because of the accounts payable. All right, you're right. I'm sorry. So 38,000. Yep. Thank you for pointing that out. Okay, so salaries, you're going to decrease it because the payable went up. So you're not paying your employees. So that's the difference there. So that's what we'll focus on next Tuesday in doing the direct method.
So what do you do like in real life?
Well, in real life, you've got a cash receipts and a cash disbursements journal. So, when you get to the end of the year, you just look up how much cash your customers sent you throughout the year. But, here we're just given an income statement and a balance sheet, so we've got to calculate it. Does that make sense to everyone? All right. Sorry for the confusion.